how you can make your own portfolio. Last time we've covered how you can invest into Vanguard life strategy funds, and today I'm going to try to explain how you can make your own fund. So the way I think about it is that all the money that I have for investment, that is aside from the rainy day fund. So in this example, I just took a simple £10,000. That's 100%. And what I'm going to do, I'm going to divide all my money into 3 groups. So long-term investment, this is something that I'm consistently going to invest in whenever I'm going to have free money, and I'm not going to sell these assets. So generally the way I think about it, it's long-term trends, something that I believe will always be there, and I think it's a good idea to invest in a broad economy. So yeah, this is something I don't touch. Midterm trends are the ones which I think are current and maybe a little bit hyped. For example, maybe you've heard the green energy is pretty much on the rise, and electric vehicles on the rise. So everyone is talking about it. So these are the things that you might benefit from. And then risky assets, I consider as something that I'm interested in investing and playing with. So here I would take maybe some individual stocks. For example, I might choose something like Tesla if I'm a risky type. Now, as you can see, these are the percentages, but you can play with them as you want. So I put, for example, 60% of my savings I'm going to put into long-term fund, and 30 into mid-term, and 10% to the risky. But it's up to you, and you may choose to put all 100% into the long-term fund and not bother with the smaller trends or with the individual stock. Again, it's totally up to you. It's your risk levels and however you want to spend your money. Remember, in the life strategy funds that we've discussed previously, Vanguard does balancing for you. So if you decide to manage your assets by yourself, you need to do it yourself. So technically, say £10,000 you have now, but over the next year you can be able to save, say, another £2,000. You will have to allocate it accordingly to the long-term portfolio, to the short-term, and to the mid-term portfolio. Now, I've made an example. So how would you go about investing into the long-term portfolio? So I've just made this example for you. So before you go anywhere, I suggest you just think, what are the trends you believe in? And I think it's a really good place to start. Now, we often think that the trends are very fast in development, and things are gone before we actually can invest into them. But the fact of the matter is that long-term trends, they take time to develop. And I've read in one book by a famous futurist guy who kind of predicts the future. He says that every single trend takes over between 15 to 25 years to develop. So first you have like technology or something new that people discover. Then there's a long process of figuring out how you can capitalize on it and how you can sell it and how you can apply into it. And then after 15 or 20 years, only then you can actually start profiting on it and the companies can profit. So a classic example, he was saying that if a person falls into coma 20 years back and he wakes up in 2021 and asks, so tell me what happened, you'll be like, well, okay, we have internet, but so did you have it in 2000s? Okay, we have online shopping, but we did have it before. So the thing is that trends are very slow in development, so don't be afraid to jump into certain things. So, coming back to long-term investment, the way you need to go about it is just think what you believe in. So for me, as you can see from this table, I think, okay, the US economy is quite strong. So I'm going to allocate out of 6,000, which is my long-term investment fund, I'm going to allocate 40% to the US stock, 15% I'm going to allocate to the UK, simply because, well, I mean, it's Brexit, and overall, I think UK economy has been struggling lately, but I might change this because US is actually overvalued, so it might be making more sense to move to the UK. Then emerging markets, again, 20%. Then I'm thinking, what else can I do? Okay, actually invest into the whole world, so the best companies in the world, the ones that are paying dividends. So as we've previously touched upon it, the companies that pay dividends usually are the companies which have already grown enough, and they're not the growth companies. So they're stable in their earnings, and they don't see much opportunity where they can invest their profits, or they have enough of profits that they can pay some of them to their shareholders. Some people say, oh, these are the companies that are not going to grow well, but once the company starts paying the dividends, they try not to stop, because usually it's not a good signal, and it sends a negative signal to the market, and usually share price falls back. So usually companies try to pay the dividends. And yeah, so I think dividend companies is a good call. Some people even form the strategy on just investing into the dividend companies. And then personally, I would like to invest into the US corporate bonds, or you can invest into the government bonds. As you might have probably heard, the government bonds currently give a very bad yield, and it barely covers inflation. So for me, I choose not to do that. But I would like to have some fixed income assets in my portfolio. That's why I choose US government bonds. So here I gave you an example, but the main thing is you just need to sit and think, what are the trends you believe in? For example, some of you may be like, you know what, I don't believe in the US, I don't believe in the UK corporate bonds, or sorry, US corporate bonds, I'm just going to invest into just general world index, and that's fine as well. Just write it down that for you, you don't really care about the geographical trends, you're just going to invest into the broad index of the whole world. So basically in the biggest companies in the world, and that's that, and that's totally fine as well, because this is your strategy. So for me, as you can see, it's different. This is a sample portfolio, but it's very close to what I actually do with my own money. So what are the things you need to look at? So first, look at the geographical diversification. It's really important that you diversify well, so you cover up for the country risks. So as you know, US has been printing a lot of money, and there's been generally very soft monetary policy, and now everyone's worried that the dollar is going to depreciate and there's going to be inflation in the US. So it's good to have exposure to different markets. As you can see here, also I diversify on asset type. As I previously said, I'm still young-ish, and I want to earn a little bit more money. That's why my exposure to bonds, which are generally safer assets, is minimal. It's only 10%, simply because I kind of try to cover up for the lost years when I was not investing. And in this table, you can see how I spread my risk over different geographical locations. So once you sat down and thought about it, I'd suggest you go to Vanguard. And for whatever it doesn't, okay, now it loaded. And here you can just find the right tools for you. So once you scroll down, you can see equity. So these are all the stocks that they have. And we're going to look at the ones that I have mentioned. So for example, the USA tracker is S&P 500. I choose. Here you're going to invest into the 500 biggest companies which are listed in the US stock exchanges. Now, although the company might be listed in the US, it doesn't mean that it just operates in the US. So the likes of Coca-Cola, Apple will all be here. So how do you go about checking what's in the tracker? So one thing I need to tell you, so sorry, there's lots of souls. The S&P 500 is just a tracker of general economy, so 500 biggest companies that are listed in the US. Each fund creates its own ETF, so exchange traded fund, and they try to track the S&P 500 as close as possible. But obviously there are tiny discrepancies somewhere. That's why, although index is S&P 500, you can see that the Vanguard ETF has 507 stocks. Ongoing charge is 0.07%, and as we talked previously, it's very low charge. And for every £10,000 that you invest, you can pay £7 a year, which is a really good deal, given that if it is an actively managed fund, it's much higher. So what we're going to look at, let's have a look at the portfolio data. So here we look, okay, there are 507 stocks. Well, benchmark is actually an index. Then you can see the price earning ratio, book ratio. I mean, as a long-term investor, the reality is you technically shouldn't be looking at it, although it doesn't make sense, but I've actually done a lot of research on it, and yeah, as a long-term investor, you invest even when the market is high, when the market is low, because overall, over the years, it's gonna average out. So the main thing is to keep investing. Now, I personally am a little bit skeptical about this because especially now when it feels like the market is overvalued, I would say just keep an eye on a few of these stocks, and then yeah, there are always some corrections. Maybe you won't be able to see a big correction of 10-20%, but every 3-4 months there is a 5 to 10% correction, and it kind of feels somewhat nice to buy it when it's a bit lower. Now, it might be that you won't be able to see the correction, or you don't want to spend time looking for the price dip. It's totally up to you. But overall, the general advice is to start investing as early as possible. And yes, you might buy it on a high, but as lots of fund managers say, yes, it is a local high, but in 10 years there's going to be another local high, and overall you're still going to buy it at a lower price than 10 years down the line. Let's see how it is like geographical diversification. Well, since it's the US stock, it's 100% North American, but it's you will see that it's not true, because all these companies, they operate, most of them operate globally. So here we're going to see the exposure in sectors. So as you can see, information technology is pretty much almost 30%. Yeah, healthcare, so it's quite nicely diversified of different sectors. And yeah, here you can see the biggest holdings in the stock. So as I said, Apple, it operates everywhere. Yes, it is listed in the US, but its revenue is coming from everywhere. So there's a diversification within the company, like Microsoft, Amazon, Google, Facebook. So yeah, so here you can see different companies which are there. Now, let's have a look at the price and the performance. I usually like to see the price development over 18 months, sorry. And yeah, you can see that, okay, price had been growing, and then I look at the annual performance. Now, as you know, past performance is not a guarantee of future returns, but I still like to see what are the dips and how does it perform overall. So you can see that in 2020 it did 16% return, 2019 was 28, and yes, there was a dip in 2018, but you know, it happens. In the end of the day, that's what you're being paid for the risk. But if you would have invested 5 years back, you would have seen a nice and hefty 113% return, which is not bad if you think about it for 5 years. Definitely no bank would give you that. So yeah, and that's pretty much it. As I've said before, another thing to look at is expense ratio, very important. So we've seen that this is pretty diversified ETF with a low charge, and yeah, the size of it is quite big as well. So it's one of the biggest. The same way you can go and look at other ETFs that I've mentioned, or maybe you'll find something else for yourself. If you're a long-term investor, like I said, it really doesn't matter when you invest, but if you want to wait for a local dip, just add it to your phone and just keep on checking. And yeah, if you have any questions, do let me know. I'm sorry for the M's and R's. As always, it's my second video and I'm still not there yet, but I'm willing to share everything I know with you. And in the next video, I'm going to cover the midterm investment and how you can go on about choosing particular industries that you want to invest in. And there I'm going to go a little bit more into the details of analysis.